Welcome to the third part of our capital budgeting lecture or corporate finance lecture. One of the shortcomings of capital budgeting methodology is the fact that depreciation is an accounting value, and accounting depreciation is subject to manipulation both by the corporation and the government. Government may give us depreciation as a tax subsidy and accelerate it at the times of a recession, and we may make more depreciation than economically is justified, or we may take less to play with our profit because this is a non-cash cost. Money is in our pocket in a corporation, but we deduct this cost and pay less taxes. So can we make this depreciation more honest? That's really the topic of this question. And the question is calculate and interpret accounting income, what we have done so far, and economic income, really doing market values for depreciation in the context of capital budgeting. Okay, we want to do economic depreciation, but how can this be done? Well, an example is the best way to illustrate this, and this example involves a nice little trick which I would want to call your attention to. Here is the example. A corporation called Omni has a project that is costing it $25,000. Cost of capital is 12%, and the future after-tax cash flows for the next 3 years are 10,000 in year 1, 12,000 in year 2, and 15,000 in year 3. We are going to calculate economic depreciation. First, let's calculate our net present value or beginning market value. So our first market value or our first calculation of market value is exactly the same as present value. The 10,000 divided by 1 plus cost of capital, 12%, 12,000 divided by 1.12 squared, and 15,000 divided by 1.12 cubed. And that gives us 29,172. And of course, we can deduct cost from this, but this can be taken as market value of the project because the project can be considered a black box that spits out these 3 different cash flows in the future. So the project is worth 29,172. And of course, to calculate net present value, you subtract the initial cost of 25,000 from this present value of future cash flows, and you get a net present value of $4,172. An old hat calculation for us. Now let's go and calculate depreciation so that it's market value. For the year 1, we say, look, the project is worth 29,000. That's our wealth. We own this project. But after a year of operation, the first cash flow of the project, which is 10,000, let me mark it here, is gone. So then we have the project for year 2 and year 3. So we discount 12,000 at 12% for 1 year and 15,000 at 12% for 2 years, and that gives us a value of 22,672. Now here is the nice little trick about the market value of depreciation. We say this project that was an asset worth 29,172 after 1 year is an asset that is worth 22,672 based on the two cash flows that it generates in the future. So the difference between these two numbers, or 6,500, is a market value of depreciation. The project has gone down, its market value has gone down by 6,500. But it had generated an after-tax cash flow of 10,000 in year one, and the difference is 3,500 economic income that we had. Our wealth had increased because we own the project. Project has gone down in value by 6,500, but we made 10,000 income, so we have 3,500 extra. Then we go to year two. Now we have a project worth 22,672, but it only generates one cash flow in the future, and that cash flow is 15,000. If we discounted one period divided by 1.12, 12%, it's only worth 13,393 in year two. But we started the year with a project that was worth 22,000 some, and it dropped to 13,000 some. The difference, or 9,279, is a reduction in value of this project because, let's say, the machine had gotten older and lost 9,000 of market value. But that year we make 12,000 income. The difference between 12,000 and $9,279 is $2,721, and that is our economic income in that year. We lose money to real market depreciation, and we make money from the cash flow. Then we go to the last year of operation. In the last year of operation, we make that 15,000 cash flow. Our project has $13,393 beginning value coming from year two, and in this year, the value of the project goes to zero because it has no more future cash flows. The difference between 13,393 that is lost, value of the entire project, and 15,000 that it makes us cash is 1,607. And of course, the nice thing about this calculation is that economic income, when it's divided by beginning market value, in each case gives us 12%. 3,500 divided by 29,000, 2,700 divided by 22,000, and 1,600 divided by 13,300. These are all 12% economic rate of return. So accounting income involved looking at bottom of the income statement, reading of profit, which already had depreciation deducted from it, and this depreciation affected taxes, and then we added depreciation to it, and then we went to cash flows. But this market value of depreciation can be calculated differently. Accounting income is reported net income on the firm's financial statement. Computation is nothing more than constructing a firm's income statement. This differs from economic income. Accounting depreciation is based on original cost of the investment, not the market value. And of course, depreciation method given to us by the accounting field and influenced by government decisions or regulatory decisions. Financing costs are separate in this methodology. Let us next focus on economic profit. What CFA calls economic profit is what in the field is called economic value added. Here I have it. And EVA is a registered trademark of a consulting firm called Stern Stewart. Perhaps that's the reason that instead of using EVA with a registered sign, in CFA they use economic profit. The EVA concept says that every stakeholder should be paid, and that includes the providers of capital. So you multiply WACC, or weighted average cost of capital, by amount of capital, and you subtract it from NOPAT. NOPAT is the profit of a firm that has no debt. And this is to prevent a corporation from borrowing a lot and using debt tax shield, the fact that interest is deductible, in order to pay less taxes and make money that way. Makes the playing field uh, even. You say, let's evaluate the management's work and the profit they have generated by pretending that they are all equity finance. So NOPAT is the profit of an all equity finance firm, and that firm would have a um, debt of zero. To calculate NOPAT, we get earning before interest and taxes, profit before we pay interest and we pay taxes, and then we pay taxes on it. That's the same as multiplying it by 1 minus tax rate. It makes it after taxes. Well, in um, reality, we pay taxes on earning before taxes after deducting interest. But if interest is zero, earning before interest and earning before taxes are the same. You deduct zero from EBIT and you get to earning before taxes. So this is the profit of a firm that has no debt. It's all equity financed. Here is an alternative formula, and this alternative formula says that every period EVA should be calculated, economic profit should be calculated, and then discounted at the weighted average cost of capital. And you're basically calculating the present value of all these future economic values. And we call that market value added, or MVA. Another alternative valuation model is residual income. This valuation model is quite popular, and it looks at what kind of return the owners make. So we look at net income minus an equity charge, basically deducting the cost of equity capital. And that's the kind of return that equity holders get. So equity charge equals the required return on equity multiplied by beginning book value of equity, which is a proxy for how much equity we have. And this equity charge is subtracted from the net income we make, and what remains is an extra income for equity holders. So this residual income is how much more money do the stockholders, if it's a public company, equity holders, owners, make in excess of a fair required return on their money given the risk of the corporation. So this residual incomes, or extra returns to equity holders, are discounted by a return on equity, not by weighted average cost of capital, because here only we are focusing on equity holders. And these present values are added up, and we get net present value of the project. Our last alternative valuation model is to value equity and debt separately. And to do this, we look at the cash flow that goes to debt holders, those who lend us money or gave us debt capital, and this cash flow is interest on our borrowing and, of course, paying back the loan, the principal of the loan. And all of this is discounted at cost of debt capital, which would be different from cost of equity capital, and it should be lower. And then we calculate cash flows that go to equity holders. They get paid dividends, and if we purchase shares, they would receive money. This is also discounted at cost of equity, and then these two values are added up. The problem with this is that equity holders may receive no dividends for quite a while in a growing field, firm, and this might be an issue that makes this sort of calculation difficult. The next topic in CFA Level 2 is M&M theorem. We affectionately call Modigliani and Miller's theorem M&M theorem. Um, they both won the Nobel Prize, not so much because we practically use the theorem, but because a lot of knowledge and understanding in corporate finance was generated based on the research. The research is the foundation stone for future understanding. Our learning objective is to explain the Modigliani-Miller propositions concerning capital structure, including the impact of leverage, borrowing, taxes, financial distress, agency cost, and asymmetric information on a company's cost of equity, cost of capital, and optimal capital structure. Capital structure. The issue here is how much borrowing or owner's capital should a firm use. Determine the mix of debt and equity that minimizes the firm's WACC or weighted average cost of capital. Or alternatively, figure out how much to borrow or how much owner's capital to use in order to maximize the stock price. This issue is called the optimal capital structure, and in a nutshell, in one sentence, M&M say that optimal capital structure doesn't exist. Capital structure doesn't matter. It doesn't contribute to wealth. But of course, that a statement becomes a lot more complicated as we focus on their assumptions. So let's take a minute and do that. Here I want to quickly review WACC or weighted average cost of capital. If we have debt, we have interest as cost of debt, and if weight of debt is, for example, 10%, we multiply that by 0.1, and then weight of equity would be 0.9, or 90% of our capital is equity, and we multiply that by cost of equity capital, KE. Because debt is tax deductible, it saves us taxes, so we multiply this cost by 1 minus D and report it as an after-tax cost. A good way of remembering this is that if interest on debt is 10%, this 10% charge would be deducted from our profit, and if our profit is taxed at 50%, 50% of this 10%, or half of it, or 5%, is a saving from taxes. So this 5% reduces the 10% cost of debt to only 5%, 10 minus 5. So even though we pay 10% charge for borrowing, we save 5% because of this borrowing on our taxes, and we end up paying only 5%. So we have to calculate after-tax cost of debt. Okay, so that's the weighted average cost of capital. We average this cost of debt and equity, and for weights we use the amount of debt and equity, but we consider that debt is tax deductible. Let's go back to M&M proposition number one. In a world of no taxes, no transaction cost, no cost of financial distress. We could simply say that this is a world of no frictions. And that brings a very good analogy in mind. The same way in physics that we drop a stone and a feather in vacuum and we look at uh, how they fall. Here too, we are generating knowledge by looking at a vacuum, a world of no taxes, a world of no transaction costs, and a world of no financial distress, in order to figure out what really matters, which one of these impose how much cost. So in this world, really what matters is how we make products and sell them and generate a profit. It doesn't matter if our capital comes from our owners or our owners loan us the same money. Value of a levered firm, a firm that borrows money, is the same as the value of an unlevered firm, the one that is completely uh, financed by owners' capital. M&M have a rather sophisticated proof, but it amounts to saying, look, the output pie matters. How we divide it between the owners and those who give us debt capital uh, doesn't matter. So we have the same pie here, and if we give 40% to equity and 60% to debt, or 60% to equity and 40% to debt, the pie doesn't shrink. The economic value that we generate is the same. Capital structure is irrelevant in M&M's proposition 1 with no taxes. The output pie is the same size no matter how you slice it. So what matters is ability to produce wealth, and then sharing it between debt and equity will not shrink this pie as long as we don't have frictions. Equity holders shoulder more risk. And if we borrow more, the risk of equity starts increasing even more. And they will get more return, but the return is in line with their risk. And the weighted average cost of capital doesn't change. As we substitute more debt, cost of equity goes up, and we end up with the same overall cost, even though equity holders get more return, but they get more risk. There is an M&M proposition too that we get to on later. Both of them show that in a world of no taxes, capital structure doesn't matter. And the real output is the same. However, you should share it with the providers of capital. WACC is unaffected by leverage. Now let's introduce taxes. As soon as we introduce taxes as a friction, well, debt has a charge that is tax deductible, but when we pay dividends to equity, it's not tax deductible. So they are not treated the same by the tax authority. Therefore, debt becomes cheaper. Debt creates a tax shield, helps us save taxes. Debt interest payments are tax deductible. Tax shield increases the size of after-tax output pie. So this uh, output pie doesn't stay the same if we generate uh, more uh, debt tax shield. If we pay more interest and we borrow more, the after-tax pie gets larger because we keep more of our output and we pay less taxes to the government because borrowing interest is deductible for paying taxes. So value of a levered firm is not equal to a value of unlevered firm. Value of unlevered firm plus tax rate multiplied by value of debt um, adds added to value of unlevered becomes value of levered. So borrowing is a good thing, saves us on taxes, generates value, and this analysis says go to 100% debt. Optimal capital structure is all debt borrowing. Of course, the tax authority doesn't allow that corner solution, but borrow as much as possible and as much as allowed would become the advice here. Of course, that's not an advice that we take seriously in practice, so we want to know what causes people not to borrow so much. And right away, bankruptcy comes to mind. Let's look at M&M proposition 2. It says, look, cost of equity goes up as you borrow more. So the horizontal axis is percent of debt in capital structure. As you borrow more, cost of equity goes up. And weighted average cost of capital goes down. Um, because you save on taxes. Both propositions 1 and 2 show that in a world with taxes, firms should go to 100% debt as high as possible. All right, let's focus more on M&M proposition 2. It states that cost of equity is proportional to amount of borrowing, and it increases with borrowing. And that would be the straight line that we have here for cost of equity. Cost of equity increases as debt in capital structure increases. However, cost of capital here, WACC started going down because when we borrow more, we have a tax shield, and this would make debt cheaper. It saves us more taxes. Equity becomes more risky as we borrow more, and cost will go up. But debt um, would save us more and more money because interest is deductible for tax purposes, um, and this would lead to a lower weighted average cost of capital. So proposition 2 also says that optimal amount of debt or borrowing is uh, all debt financing if there are taxes. Both proposition 1 and 2 show that in a world with taxes, firms should use 100% debt or borrow as much as they can. And of course, the reason is that this debt tax shield, or the fact that borrowing saves us um, from paying taxes, interest is deductible, increases the size of output pie and that both debt holders and equity holders can share. The wealth increases because we pay less taxes. No, you could imagine that this may not work in practice, partially, as I said before, because the government, the tax authority doesn't allow us to do 100% debt financing. The other immediate cost that comes in mind is bankruptcy. As we borrow more, bankruptcy becomes more costly. There is a lot of theoretical discussion of exactly how bankruptcy costs affect optimal capital structure, and Miller has a nice analogy. He talks about a rabbit and horse stew. Take a rabbit, take a horse, and make this a stew. Well, the stew would be mostly a horse and very little rabbit. Of course, a lot of you might be disgusted by those meats, but the point is not killing the horse and rabbit. The point is that bankruptcy costs are not so huge when they compare to the huge savings that death tax deductibility or tax shield will give us. Then this got researchers into studying direct and indirect bankruptcy costs. Yes, direct bankruptcy costs are not so huge. This is cost of going to court and paying for bankruptcy. And if our products are still good and we can generate cash flows in the future, the company would run. Plus, bankruptcy is a possibility, therefore we have to multiply it by its probability and calculate expected value of this cost. And if the chances are not very high for bankruptcy, this expected value becomes even smaller. But then it comes on the fact that you and I and the workers and the managers of this firm would lose our job in case of bankruptcy. And then there is a huge discussion of agency cost. It means that one class of stakeholders, such as managers, are more concerned about their own interest. The firm would go bankrupt, and the manager, would lose my job, and that's a huge cost. And because of it, bankruptcy costs are a lot larger, or this agency cost makes them put a brake on how much they borrow. There is also discussion of asymmetric information. Insiders have information that outsiders don't, and that affects the cost of borrowing. And there are other market imperfections that give us additional cost and make 100% debt financing or huge amounts of debt not possible or not cost effective. Finally, De Angelo and Masilus, in a very influential paper, talk about tax uncertainty. They say that although we get this debt tax shield by using more borrowing, we may not be able to use all of it. Taxes are uncertain. They depend on us making enough income in the future to use these tax deductions. And of course, government may not allow some deductions, and there is always that uncertainty. Given all the tax shields that the firm has available, large debt tax shields may go unused in low payoff states of nature, and in bankruptcy, they would also go unused. Therefore, we have to multiply this tax saving of the debt with a probability of realizing this saving and calculating an expected value, and that would also make it small. Let's focus a little bit on cost of financial distress. We should be able to define it in a CFA exam. These are costs that are incurred when companies have trouble paying fixed financing costs, paying their interest, for example. Suppliers and other stakeholders smell debt of a company. Therefore, there would be indirect cost. We would lose customers' trust. So, indirect cost is losing suppliers, losing customers, people not dealing with us because bankruptcy had become more likely. And of course, there are direct costs of bankruptcy, cost of attorneys, and court costs that are actually involved in bankruptcy. We should be able to distinguish between this direct cost and indirect cost. And of course, this probability of financial distress matters. Higher operating or financial leverage leads to higher probability of financial distress. Better corporate governance lowers this probability of financial distress. Agency costs are something that I already talked about. Let's make it more concrete in this slide. Agency costs are cost of conflict of interest, and in this case between managers and owners. So owners may like more debt, but managers don't like it because it makes their job more risky. They may lose their job. Also, this payments on debt, regular payments, keeps managers on their toes. They have to work hard and make these payments. That's positive for the owners, but not necessarily nice for the managers who have to work hard and have the stress of making debt payments. Uh, Three different types of agency cost of equity are considered here. Number one, monitoring cost. Better corporate governance allows one to um, discipline management and provide conflict resolution mechanisms that allows these agency costs to be lowered. Bonding costs. These are things like non-compete agreements that bonds a manager to the corporation and reduces the cost of conflict of interest. And then there are residual losses from second best contracts because the managers are working for their own best interest. They're not producing the optimal output that the owners uh, uh, like. And therefore, um, we get a second best contract, which is a contract that makes managers work optimally for their own interest and produce something that is lower than optimal for the owners. Greater financial leverage reduces agency costs, and um, this makes managers to have less free cash flows to squander and um, lose. Cost of asymmetric information. As I said before, asymmetric information is when one side has information than the other side does not have. Managers know more about firm, its prospects, and its products than the owners do. For a public firm that has dispersed stockholders that have few shares of stock. Investors only pay if they are convinced of the value. So the burden is on managers' shoulders to um, convince the market that their project is worthwhile. Insiders of the corporation bear the asymmetric information cost. And of course, this lowers the values. Um, Costs are higher if complex products are produced, and when financial statements are not so good, they are poor, agency costs become higher, and it becomes more difficult to convince outside investors that we indeed have good projects that will pay off later on. So managers know this, but they can't convey it to the market. The valuation implications are that certain actions would serve as a signal. One of those actions is offering more stock. Stock offerings are a negative signal. They say, look, the managers didn't want to keep the stocks themselves. The owners didn't want to keep their investments. They want to get more stockholders and they want to sell out because they have information that is not so positive about this firm. Debt offering is a positive signal because now the managers are avoiding to sell undervalued stocks, and payment of debt keeps them on their toes and makes them to produce more. In practice, most firms have a target capital structure. That means they want a certain percentage of debt in as their capital. They are shooting for a certain amount of debt as a percentage. This target capital structure exists and it's well documented in corporate finance. So this practical fact could be explained uh, at least two ways. Um, um, One is that somehow this various cost of debt financing eventually makes uh, benefit of the debt to wash out. Um, the other one is this pecking order theory. Let's first focus on this pecking order theory because practically it does have a lot of promise. Um, the word pecking order comes from chickens, and so it's in a sense funny. The stronger chicken uh, pecks the other ones, and then the other chickens are lower ranked. And this talks about what is our first capital that we go after, and practically this works. Internally generated funds are most favored. So if we run a project and this project makes profit, um, that would be used as capital first. Um, there are several reasons for that. Obviously, one reason is that if the project had already generated funds that we can use as capital, it's a good project. We've seen that it generates funds. The other reason is that our own funds are less costly. We don't have to pay transaction costs to raise this uh, capital. The second item on pecking order of capital structure is debt financing. So this theory says debt financing is attractive for several reasons. Not only we have this debt tax shield, but also regular payments on debt disciplines the manager, makes them work harder and produce more. When we go to borrow, especially if this is bank loans, bankers would scrutinize our project and put their stamp of approval on it. And this stamp of approval means our project is good. Therefore, debt financing has that extra value. Finally, at the bottom of this pecking order of financing is issuing new equity. It's least favored. The market doesn't like it if manager goes back to the owners and begs for more money, for owners to put in more money. This theory is based on signals, and it essentially says managements who have inside information send a signal by these actions, particularly by issuing new equity. They signal that they have not generated new funds and their projects is not good enough to qualify for borrowing in capital markets or in bond markets. Investment bankers who underwrite the bonds uh, say that your debt capacity has been reached and perhaps their credit rating would be affected by issuing more debt. So issuing new equity has this um, signal. Finally, we should know the static trade-off theory. This is an older theory, essentially in its original form, saying that if we borrow, we would save on taxes, but we would add bankruptcy costs. And essentially, these bankruptcy costs are going to counterweigh this um, tax saving. There are more sophisticated versions of this theory, for example, D'Angelo and Masuras that I talked about before, and they say that this um, financial distress is not the only thing that counteracts the tax benefit of debt, but the tax benefit of debt is uncertain and is smaller, and it gets smaller and smaller as we borrow more because we are less certain about using it. At some point, value added by tax shield is exceeded by value reduced because of cost of financial distress. This point is the optimal capital structure. So the important thing about this static trade-off theories is that it says an optimal capital structure exists. The alternative is that there is no optimal capital structure, but firms have a target capital structure, and it's based on industry level, and that pecking order theory says how they go about raising capital, and that affects their capital structure, and that is done when they don't have internal funds. And by the way, that to some extent explains why government gives a debt tax shield, because if internal funds are not available, then debt is the way to expand the firm and hire more people. And equity is not the way to go because it's at the bottom of the pecking order of capital structure. Pecking order theory says issuing new equity or seasoned offering is something that would drastically reduce the value of the firm, because it gives a signal about a firm that is not healthy and can't borrow. Graphically, this static theory, the static trade-off theory, is explained by an optimization curve as follows. On the horizontal axis, we have percentage of debt in capital structure going from 0 to 100%, and on the vertical axis, we have the value of the firm. And as we borrow more, this debt tax shield um, increases the value of the firm, but when we subtract the cost of bankruptcy, cost of financial distress is something that is subtracted or is this value, and in here it's smaller. As we subtract that, we come to a curve like this, and eventually it has an optimum where too much is subtracted because of bankruptcy costs, and a small amount is added because of uh, the debt tax shield, saving from taxation. So you get this curve, which has a this curve that has a maximum. My drawing is not as nice as the one I have here, but the maximum point is here. Optimal capital structure, and this would give us maximum firm value, and firm value is really on this curve. After you subtract the cost of financial distress or cost of bankruptcy. So this theory says a static trade-off theory says that optimal capital structure exists. Uh, the pecking order theory is consistent with optimal capital structure existing or some target capital structure, um, or moving toward a certain type of capital structure, but not necessarily an optimal one. In practice, there is an actual capital structure that the firms have, and there is a target capital structure that most of them seem to go after. Target capital structure could be taken as this theoretical concept of optimal capital structure. After all, firms are targeting this, so this must be optimal. Mm, but most of the time their capital structure is different from the target. Capital structure may deviate from target, and that says, well, maybe capital structure is not such an important concept, and capital structure irrelevancy has some role to play. Um, Firms may also exploit opportunities in a specific financing source when, for example, for some historical reason, equity is cheaper and equity risk premiums are lower because of the good economic times, etc. Or they may take advantage of market valuation of their firm and um, issue equity where their firm is overpriced, for example. The next goal, learning objective, is to look at the role of debt rating in capital structure policy. As the rating agencies lower the rating of a corporation, it would have a higher default risk premium and a higher credit risk. And then their cost of capital, which is tied to this debt rating, would increase for issuers issuing new debt. And of course, the value of the old debt or old bonds will go down. Managers try to maintain certain debt rating in order to minimize the cost of capital. In other words, there is a debt capacity that once you reach that, borrowing more may reduce the uh, rating of the corporation, especially if times randomly become tough, and this would increase cost of um, capital. In a sense, these ratings convey that cost of capital is quantum. It jumps after a certain point to a higher interest rate, to higher cost of capital. We as the corporate managers want to avoid that point if we are close to it. An increasing debt rating will lower cost of debt and cost of capital, so it's desired. Finally, we want to explain factors that someone who analyzes and evaluates the impact of capital structure policy on valuation keeps in mind. Uh, Evaluating capital structure policy. The factors that are considered is changing capital structure over time. So usually we look at capital structure of the firm, compare it to industry average, and we look at this capital structure for several years and see how it changes over time. Is it getting closer to the industry average or away from it? Capital structure of competitors with similar business risk, and of course agency cost. Higher quality of corporate governance gives a lower agency cost and less debt in the capital structure, because debt usually um, gets rid of these agency costs, keeps management on their toes to work harder and service debt. So if we have good corporate governance and less conflict of interest between managers and owners, perhaps we don't need as much debt. There is, of course, international differences in leverage, and it depends on availability of equity capital, and it depends on agency problems in different countries. Here is a table that summarizes international leverage. If a country has a strong legal system, their total debt is lower, perhaps because there is more safeguards for owners. Um, if a country has less information asymmetry and we know more and there is more disclosure about the value of the firm, debt is also lower. Uh, we put more equity in. Owners feel easier to contribute capital. Favorable taxation of dividends and capital gains would also help owners to contribute more capital, and debt would be lowered. Um, and then we have two types of laws. One is called common law system, and the other one is called civil law system. Countries that have common law have lower amount of debt than countries that have civil law. Debt maturities for how long we borrow. Uh, Countries that have strong legal systems have longer debt maturity, they borrow for longer. Countries that have less information asymmetry borrow for longer. Favorable taxation of dividends and capital gains doesn't affect debt maturity. And countries that have common law borrow for longer period than countries that have civil law. US and UK firms issue less total debt than Japan and France. US firms use longer maturity debt than Japanese firms, and these facts go with the fact that US and UK firms have common law, and Japanese firms and French firms have civil law. Civil law versus common law. Civil law countries, the legal system is based upon principles usually rooted in the old laws of the Roman Empire. Legal code is updated, judges must take rulings strictly based on legal codes and statutes. Analyzing past judicial interpretation of the law is done for advice. The system is a stable legal system. France, Germany, and Spain are modern examples of countries who use civil law. Common law countries are legal systems that are based primarily upon past judicial opinions, so past cases matter a lot. Judges interpret the law rather than taking it as a literal requirement, such as under civil law. So this code evolves and changes with judges over time as times change. Thus, the law may be altered by a single ruling. This practice is flexible. Examples are UK and former British colonies such as Australia, India, Canada, and the United States. And probably you know this uh, difference, particularly the civil law, from movies and what you hear about US. Um, Politically, people try to set new precedents, so the laws are changed rather than actually changing the code.